When you're trading options, Fidelity has just what you need with straightforward but powerful tools to help you select a strategy and execute your ideas. And they offer a wide range of information and insights to help simplify your trading experience. Have a question? Ask it live during their small classes and coaching sessions. Need information? Check out their educational videos, articles, and webinars. See why it's easy to trade options your way at Fidelity. Start now at fidelity.com/options. Options trading entails significant risk and is not appropriate for all investors. Certain complex option strategies carry additional risks. Before trading options, contact Fidelity Investments by calling 800-544-5115 to receive a copy of Characteristics and Risks of Standardized Options. Supporting documentation for any claims, if applicable, will be furnished upon request. Monday, May 20th. I'm in hockey withdrawal, number one, but that comes back Wednesday. The Knicks, I got to be honest with you. I mean, good for them.
Yeah.
Gutsy effort.
Yeah.
They got beat.
They
cut it to 6 in the third, and then
banged up.
Josh Hart throws up a brick, and then they weren't going to win that game. I'm not pretending, just so we know. But it was a good run. But Brunson then fractures his hand. I mean, it's a mash unit.
It was a horrible game. It was a horrible couple games, by the way.
I got to tell you something. Now, for the Pacers of Indiana, the test in the form of the Celtics of Boston is going to be interesting because the Bucks were banged up. Knicks were banged up. And they won. The Pacers won. Now let's see, because now you're going up in class, as they say. In horse racing terms, you're going up in class.
Well, I'm rooting for the Celtics here.
You have a vested interest in this. You have buddies with the owner.
Yeah, one of the owners he's been on the OK Computer podcast. That would be Wick Rosebeck. Yeah, he's the man. I love that guy. All right, Guy, we got a lot to do.
No. Let's go. Listen, Monday, May 20th.
We got to be out on the screws.
It's the last Monday of the month in terms of Monday's trading.
Because next week it's going to be a holiday week. It's going to be Memorial Day.
Watch this.
Bang.
Throw up the rundown. Man, wow, they're getting really good at that. Strategist. Now, Strategist Upping it's Mike Wilson.
Well, and there was the Deutsche Bank guy also. Yeah, there's Mike Wilson and there's everybody else. That's what you're going to say. I got you.
Nvidia protection play in earnings. That is on Wednesday of this week. Stock replacement strategy.
Yeah, that's for a name that you have been all over pounding the table on. But you get to a certain point. New 52-week highs, new multi-year highs. It seems like everybody's caught up to this trade. Hey, maybe there's a way to define your risk using options, Guy, and have that exposure to the upside, but without,
the ways to do that?
Yeah.
We're going to explore that.
We're going to go over all that.
So that's the rundown. Let's get right into the strategist upping the S&P target. And the one I'm obviously focused on is our friend Mike Wilson, who raised his price target to 5,400. So I think he raised his price target by 20%. He's not expecting a 20% rally. He raised it by 20%. By the way, we're within an earshot or eye shot or whatever shot of 5,400.
And it's by the end of next year. So what Mike's done is this, and we know that he's been bearish on the broad market on the S&P 500. Mike has been very generous to us in the last few years and come on our pod on the tape every quarter. And we've discussed the nuance in his calls. He was a raging bull at the bottom in 2022. He got off that train at one point. He's made some tactical bullish calls, but overall, he's been bearish. He's been talking about rotations, Guy, under the hood, right?
Which have been happening.
But for whatever reason, you know how it goes. People just want to focus on that one S&P 500 call. Hey, by the way, we get it all the time too, between Fast Money and the like. And a lot of people have short memories and they see what they want to see or hear what they want to hear. You know what I mean? But again, he's going from 4,500 to 5,400. I'm sure there's going to be a lot of folks saying, that's it.
See that?
Towel.
It's all over. He capitulated. It's, look, until you've sat in the seat, everybody likes to throw stones. I mean, it's none of these jobs in terms of the strategist are easy. And he does, listen, I know he does rigorous work. The market didn't cooperate. We'll see how this thing plays out. Deutsche Bank, by the way, similar. I mean, they see S&P rising by a little more than 3% by the end of the year. We'll see. What's interesting, though, is I guess the last man, in this case, it is man standing, comes in the form of Marco at JP Morgan, who I still think has a $4,200 price target on the S&P. We'll see what happens there, see if it plays out. Anyhow, that's the Mike Wilson update. We will have him on the podcast on the tape at some point.
No, I think he's already scheduled.
So there you go.
Hey, Guy, let me ask you a question.
Sure.
You've often said this. Okay.
I like the word often because there's a
The
T that
next
people don't,
podcast you listen to
will be the, well, I shouldn't say that because then people think, oh, you don't even,
yeah.
well, but it is
But
true.
you listen to a little bit. Okay, but it's not in your immediate diet for the
No,
most part.
I don't
but
really
you
understand.
do a lot of them. But what if I said to you,
I do a lot of
you
them.
could have a podcast in 10 minutes or under that gives you the most important market,
Impossible.
business, politics, okay, maybe a couple other things, economy, and then in under 10 minutes.
How is that? And I would say to you, that's really interesting. How is that? Do you speeding it up? Are you doing it like 3 times
let me tell you something.
speed?
We are using generative AI
to
create. Well, that's us. That would be the Risk Reversal Media company here. We are using generative AI to create a daily podcast that's going to give you an update on all of those topics. And here's the best news about it. You don't have to listen to Guy's voice or my voice.
Maybe they like my voice.
We are curating, our team is curating the stories. It's going to drop right after the market closes. It's called the Market Matrix. Look at that thing. That's pretty badass, as you would say.
Full screen of that again.
Yeah, it's pretty beautiful.
I mean, look
you
at
see
that.
what's going on over there. Okay, it's going to drop. So here's the deal. You know what to do. Go to your podcast stores, wherever you get your podcast. Go follow that. Okay.
Can I do that right now?
Yeah.
I'll wait for after
today is going to be the very first day that we do that. We're really excited about it. The whole team worked on this. The product's going to continue to evolve a little bit, but give us some feedback. We'd love to hear about it.
Graphics
and
there.
Yeah, it is. Timmy really killed that. So share it with your friends. Tell everybody about it. We think you're going to really enjoy it. And we're not going to even tell you the name of our AI voice bot because it's pretty dope.
Oh, so I shouldn't
dox. You shouldn't dox
him or her.
All right. That's
hold on 1 second. Put that back up real quick. You know what it looks like? It's like a black hole. Like once you go in,
you can't get out.
Is that what the Matrix is? Matrix is?
It's a little bit of that.
I've never seen that movie either.
It's amazing. It's one of my favorite movies. It's in the top 5. And again, I don't expect you to like it.
Okay, that's
all right. But Guy, we got to get to a bunch of stuff here because we got to get out of here, like as we say on the screws. So the Mike Wilson thing, we love Mike. Mike is far better of a strategist than a lot of folks on the Twitter want to give him credit for in the things that they're going to say. Let's look at the S&P 500, Guy. We're kind of making a little bit of a flag above the prior all-time highs from a few months ago. My view was going to be that we sold off into earnings. Earnings were better than expected. There's no doubt about
Elizabeth
that.
and I actually did our podcast this morning, which may have dropped already. And we actually talked about EPS growth, earnings coming in, I think 7.3% for the first quarter, better than expected. But I mean, yes.
Yeah. So that's happening. Okay. And supportive of equity valuations here. I think, our main man Butters over there at FactSet, he's suggesting that the forward PE of the S&P 500 right now, looking at consensus, is 20.7. That's above the 5 and 10 year averages. I think 19.3 and 18.7 or something like that. So again, you better get that, earnings growth kind of to support that going forward. But guys, the one I want to look at right here is yields. And this was interesting to me because we were in this really well-defined uptrend, right? And we broke that. Look exactly where we got support last week at that 200-day moving average. Now, you could say the lower band of that uptrend that was support is now resistance here. So this is a really important level, in my opinion, from pure technical standpoint.
So full screen this so people can get a better glimpse of it if we can. Because what I'll tell you is, that channel's been in place. We've drawn that for a while. We broke down through the channel. We thought correctly, one thing I did get right, it would hold the 200-day moving average, and it has held the 200-day moving average. But those moving average are coinciding. I mean, look at the 50 and the 200-day here. So this is pretty interesting. You don't often see it. I mean, they're within a whisper of each other. By the way, you also had the 50-day cross the 200-day to the upside, which typically means that trend will continue. So we'll see if this little downdraft was exactly that. But the point you made is exactly right. So are we going to stall at the channel being probably 4.5%? So we're going to stall if yields go higher, will they stop at the upper end of that uptrend channel, or will we go blowing through it once this was a bit of a false breakdown? That's the rub right here. Now, I'll tell you, I still think yields go higher. So you know what camp I'm in. Others will say, you know what, we're trending back to an area that should be huge resistance and we will fail. That's going to be what the market obviously hinges on, I think. So here we are.
Well, I'll just say this, that again, let's say we get rejected here at 447 or whatever that is, and then let's say we get into June and we start having some softer sort of data. We have some softer inflation, sort of data also. Like this thing's going back to, I don't know, that low from March or so, which is probably 415. Now, the flip side of that is if we see, let's say, the economy is doing well, which is be commensurate with what you're seeing from earnings growth in Q1 and the Q2 guidance that we saw, well, then, inflation starts to pick back up again. Geopolitical stuff starts to pick up a little. You're going to have this thing threatening 475, that prior high, and then look at what the upper end of that band is.
Yeah.
It's the prior, it's a 52-week high up near 5%.
It's fast. The 50-day crossed the 200-day on the way down. Yeah. That was a false break. Now it's crossing it on the way. We'll see. I mean, there are a lot of reasons to think yields can go lower here. Soft economic growth, right? Maybe unemployment starts ticking up, another disappointing GDP print, a number of different things. The flip side is, and things that we've talked about in the form of commodities, industrial metals, soft commodities, they're all on their horse, which makes the inflation job that much more difficult. In addition to what's going on in Japan, theoretically what's going on in China, and all the bond issuance is coming up. So you can listen. It's a coin flip. I get it. I think yields are going higher.
I got a little trade for you then, if you agree with that. Let's throw up the TLT really quickly here, and let's draw a line from the late December highs, which was just above 100, and let's just attach it to all those basically lower highs that the TLT has made, if they just want to pull that up really quickly here. And so to me, this is always interesting. Like the 200-day guy is right at that prior high from just a couple days ago or so. It's come off just a little bit. There it is right there. And so if you were looking for a breakout above, right, if you want to get, in a 10-year yield here, then you're going to see this thing threatening a little bit of the high 80s, maybe 87 is that prior low on its way to 85. If I just look at the options here, maybe you want to kind of target something in June on a near term, or something as far as July is concerned. Let me just pull up the options chain here. I'll do that on my.
As you're doing it, I'll take a look. I mean, we've been in a downtrend in terms of the TLT since basically January, right?
Yep.
I mean, if you can see it as clear as day. So downtrend in the TLT means yields have gone higher. Along the way, we've had pullback in yields, and that's obviously the TLT bounce into this trend line. So there you go. I mean, if you think we're going to break through this downtrend line, you effectively think yields are going significantly lower, then have at it. If you think we just stalled, again, in this case, at the 200-day moving average in the TLT and that downtrend line, and you think we're just basically making a series of lower lows and lower highs, you obviously think yields are going higher, and that's how you play it.
Well, I'll tell you this. So again, if you would just want to kind of consider a move back to those recent lows, 87, and then 82 is essentially the low when the 10-year yield was at 5%. Let's just say you think we got back above and we get to the higher end. If you look at July expiration, the 91 puts, the stock or the ETF is trading 91.20 right here. The 91 puts cost about $1.60. Okay, so you can do the math. You get a break even at 89.40. That seems pretty reasonable. And then if you look at August expiration, the 91 puts are about $2. So again,
that still seems reasonable to me. That's just, I mean, I'm trying to do back of envelope math in my head, but the August 91s for $2 in this environment seem reasonable, especially when you saw the low in November, I think was 82.42 or something in the TLT. So, if you start to get, if we fail here, again, fail on the upside in the TLT, which I think is going to happen, and yields start to go higher, I think this move is going to be precipitous in terms of the move lower in TLT and the move higher in yields.
Yeah. Okay. So let's get back to earnings for a second here, guys. So, there's still S&P earnings. We've been talking about retail earnings. There's a whole host of these. The Nvidia on Wednesday is the big one. We'll get to that in just a minute. Thoughts on some of these retail names, what you saw last week? Okay. You want to focus on Target.
That's the one that, look, Lowe's is what, Lowe's and Home Depot. I mean, I get it. There's similarities and not similarities. It's Target. And we saw, I don't know, you actually flagged this headline earlier today, but Target announced they're cutting prices on 5,000 items, and
everyday items. They say
every day. Well, yes, everyday items.
Yeah,
some items I use more each day than others, but we won't go there. What is that? What are they seeing that's forcing them to do that? More importantly, and I think this is what you want to focus on, is that the start of maybe a price war with some of these? So there's the rub there. So are they getting ahead of something that they see? Or are they trying to do this, sort of in a magnanimous gesture? I don't think that's what it is.
Well, think about this. If they're having pricing pressures there and they, again, maybe that's because Walmart or Costco have lower priced everyday items, right? Let's say their margins are weak when they report. This is one way to get in front of it, is talk about how they're basically going to compete on price. And maybe you get people, from a marketing standpoint, that's a good headline, right? Come to Target and get lower prices on whatever that means. Okay. So,
well, yes. Agreed.
Yeah.
Except that's Walmart's tagline for forever.
Yep.
So everyday low prices. And then there's something more to this, I think. So I think there are many chapters left in the story. There's a reason why they're trying to get ahead of something. I haven't been able to figure it out entirely. I think I know, but let's see how it plays out.
Guy, so a $12 implied move on a $157 stock, you can do the math, it's about 8% or so. That seems really hefty, doesn't it? And look at the move that the stock had, that huge gap 3 months ago, and made a new high after a short pullback, but it's basically filled in most of that gap. So over the last 2 quarters, there was a 12% gap. There was an 18% move after the prior quarter. And the last 3 quarters, the stock has kind of moved higher after results. So interesting, 5 up moves over the last 5 quarters. And this one is kind of coming into it with a different sort of feel here.
My concern, I'm just throwing it out there, and understand that I'm always concerned about something. I am the half empty person. I think people have come to understand that. They report on Wednesday, right? You just heard this announcement. This says to me that they're going to have an inventory problem again. That's just me trying to
How do you get rid of too much inventory? You lower prices. You make it more enticing to people.
Yeah. So we'll see. I mean, and that's juxtaposed to Walmart, which obviously has gotten, if you go back and look at the Walmart quarter, their inventories were down, I want to say like 27.5% year over year, which is significant against the sales growth that they saw, which is why their margins hung in there, which is why the stock is effectively trading at an all-time high. So there you go. Again, that's just me trying to read some of the tea leaves here. I'm not suggesting I'm right, but that's how I sort of dissect this entire thing.
Yeah, and then on the flip side, TJX, they report, I think, also on Wednesday. If we throw that chart back up there yet, is Wednesday. It's probably pre-opening is my guess here, Guy. And this is one where you talk about the benefits of trade downs. You know what I mean? We've seen some stuff on the higher end that's been kind of weak or so. So maybe TJX companies benefits from that. So that'll be interesting to see what they have to say, the read on the U.S. consumer. All right.
Stock's been a monster. My instincts suggest that those prior highs that we failed at, we're going to blow through. And I think the high in the stock, I want to say it's like 103 or something-ish. Stay tuned for that. But, TJX is a completely different animal than Target. I think we've all come to understand it. They're having to have nuts in the retail sector. And I still think TJX is one of the haves.
Yeah. $4 implied move there seems kind of reasonable.
Seems low,
on a
actually.
$98 stock or so. Trades at about 24 times this year, 21.5 times next. Expected earnings growth this year, high single digits. Next year, maybe high single digits again too. But that is obviously a margin story, Guy, and mid-single digits revenue growth there. But they should benefit from a trade down. All right, here's the big kahuna. We've been talking about it, feels like, for 2 months, especially as we got through the bulk of kind of semi earnings and then a bunch of these names that are on the Gen AI list. You see that chart right there. The sideways action, kind of interesting after such a big ramp. It had a 15% peak to trough decline, from those highs earlier in the spring. I think it was about March
8th
or so
was the high.
And then it did, it did make a new closing high a few weeks later here. So here we are at those levels. Maybe they want to blow that up for a second here. And so we have 2 lines. That 100-day moving average, Guy, is very near that low that it made just about a month or so ago. But look where that 200-day moving average is. It's at $600. I mean, the gap between where the stock is and that 200-day moving average, it just suggests to me that if the company is not able to meet the whisper and guide above going forward, then they're going to have a tough time. It's going to be on its way back towards $800 very quickly. And then if the narrative changes, this company has some very difficult comps going forward, if you think about it, right?
Well,
so give us your 2 cents on what you're expecting.
All right, so again, the March 8th is still intact, regardless of the moves, the closing high, all those things. But that March 8th engulfing pattern has not been breached yet. We'll see. I mean, that was 974 that day, and you saw, I think it closed in the low 900s that day, number one. Number two, I mean, it would have been nice if that sell-off, I think it was April 19th, got us down to the 50-day moving average. I think we got as low as like 750-ish on that day. It would have been nice to sort of tag it and bounce. We didn't. Not a big deal. What am I concerned about? Well, think about all the spend we've heard from all these different companies. I mean, spend, but the market has heard that as well, and they've rewarded Nvidia for it. So the commensurate, I think, margin expansion and obviously revenue guides got to be there.
Yep.
And maybe it will be. You know, maybe the $1,200 price targets that some people have, or maybe it won't.
Yeah.
And, you know, again, it's just a matter of time before you start to see sequential declines in margins. That's going to be the story here. When you start to see margin deterioration, and it's hard to have margin improvement from where they are right now,
right.
That's going to be the concern.
Well, you know,
that's just
they
my
guided
2
to
cents.
that last quarter. They put up like 77% gross margins, and they guided to slightly below. And I thought that would be enough for the stock to kind of take a little dip. It gapped up, 5-6% and kept on going. But then that was kind of the high, and in the March 8th, it had a huge run. And here we are. We've been consolidating. There's a great Twitter thread by Dan Niles,
the Annihilator.
The Annihilator. Go check it out. We just retweeted it here. Really good stuff here from Dan. Like, Dan was had a front row seat for what was going on in the late 90s into the kind of .com crash, and he's done some really good work. He's been on Market Call, he's been on the tape and OK Computer. Good stuff there from Dan. One thing, I just mentioned this without naming any names. I got a call from a friend of mine who runs a hedge fund and in the public markets, and he's been in Nvidia. He's been killing it in Nvidia, and he said to me, I saw on CNBC or on your Market Call last quarter, you detailed a collar strategy for long holders. And he said, I didn't want to do it then because I thought there was another quarter, but he wanted to do it now. Okay. So when I look at this chart, Guy, and I say to myself, I see that consolidation, I see that dip, I see where the resistance is, I see where the stock probably goes if they can't meet and guide up. You know what I mean? I say to myself, if you've appreciated a lot of these gains, the implied move is about $85 or so, about 9%. That's a one-day move. Now, the stock has had some monster moves after results, but when I think about hedging a stock like that into a print, I have to be more concerned about the downside than I am about the upside. And if you have 100% gains, which is what the stock is nearly up on this year, then that might be your mindset. So I think about collars. We've done them here. I just want to pull up implied volatility versus realized volatility. You see that they're very near each other. You also see the blue line, which is implied volatility. The price of options has come in of late. Usually you would see that very near that 3-month high or so into an earnings print. So the option prices are not signaling as much of a move as maybe they have in quarters past, and they don't look that expensive. There is still a little skew towards the calls, meaning the calls to buy them are more expensive, Guy, than the puts. That gives you a little something when doing a collar, because a collar against long stock is selling an out of the money call and using the proceeds to buy an out of the money put. So you can have gains up to that short call strike. You'd have losses down to the long put strike, but you defined your risk. And so I like the setup here for that. If you have tremendous gains and you're worried about extreme downside, let me give you an example of how I would do this. Versus 100 shares long at around $945, you could buy the May 24th, this Friday expiration weekly 1020 880 collar. It would cost you nothing. You're basically selling one of the 1020 calls on May 24th. Again, this Friday expiration at about $14.50. You're using that premium that you've taken in to buy one of the 880 puts for $14.50. You would have gains up to 1020. You're called away up there. Okay, you can do the math on that. That's $75 to the upside. That would be on Friday's close. If the stock is above 1020, you could always buy back that short call, leave your long stock position in place. All right, you'd have losses down to $880. That's $65, but you're protected below that on Friday's close. I just like the risk reward of this. If you are more concerned, again, about extreme downside, Guy, as you would be about extreme upside over the next few trading days.
Worst case, you get called away if they blow it out.
Yeah.
And if they blow it out and the stock's trading 1100, you're gonna be like, shit, I sold a 1020 call. I missed 80.
Yep.
Okay, that's part of the risk. And I think people understand that. And you made the point, this is a stock that's already up 100%. So with that in mind, if there is any concern at all, you've mitigated that concern by basically, it cost you nothing to put this on. right? I mean, in terms of dollars and cents, you're selling a call for $14.50, you're buying a put for $14.50, right? So you have protection. You'll be able to sleep at night for the next couple days, knowing full well that this is in place. So, as we like to say, if you get called away, that's a high-class problem to have, in my opinion. And this gives you some peace of mind, I think.
Yeah, and again, it's interesting in the Dan Niles Twitter post, he said he expects a big beat and raise, but a moderated upside move. So if you only think that, like some of the big gains, with these beat and raises, and folks are going to start focusing on, the deceleration that you're going to see on a period over period. So on a quarter over quarter basis, if you look for the balance of next year, that fiscal next year, they're going to be high single digits, which is comping versus, let's call it 100% or so. So investors might take a different sort of view on this one. And the other point is, you just mentioned, Guy, that this costs you nothing. I'm trying to line it up as a zero cost collar. If you wanted protection from 900 and lower, only 45, then you start paying for it. You know what I mean? So you sell the 1020, you buy a 900, that probably costs you $3 or $4. So again, that's how I'd be trading this. All right, Guy, the name that we kind of teased at the beginning of this in the rundown, you've been all over the commodity space.
All over the Rangers.
Well, you have been all over the Rangers, but FCX
sure,
is the name
throw that up.
It's been a final trade on CNBC for the better part of the last year. You see what's happened. That's a 5-year chart, okay, that we're looking at here. It just broke out above those highs from early 2022. That's the last time we had this commodity cycle, right? We had the Russian invasion of Ukraine, and we saw lots of different commodities going berserk. Look at this longer term chart, Guy. This is a 20-year log chart. And so I say to myself, you know what, 60, 62, you know what I mean? That sort of thing is pretty good. You've been long this thing. You've been playing this breakout over the last few years. You might want to think about expressing a bullish view in a different way. But give us your bullish take here. And do you think there's a potential for a monster breakout above those prior highs?
I mean, I think we're now at 16-year highs, right? I mean, Amanda has the chart up. So here we are. What do I think? Do I think we could blow through there? Absolutely. It's a better run company now than it was even 5 years ago, let alone 16 years ago. And you're talking about copper prices that, that we haven't seen in quite some time. So copper is clearly something going on with copper. I mean, there'll be people that say, you know what, it's a blow off top, it's going to back and fill. Yeah, maybe. Or maybe there's something fundamentally going on. By the way, it is a supply demand situation. I mean, the supply is out there, but 3 years from now, we're talking about deficits if you read some of this stuff, and the demand's not going away anytime soon. With that said, I mean, I think we're going to continue to sort of blow through. We'll see. I think we're trading 55 and change now. My target all along has been sort of those levels we saw 16 or so years ago. I think there's a very good chance we get there.
Listen, this is a great looking log chart. It looks like it's going to break out. One of the things I would just say is, like, we talk about this in stocks, we talk about it in futures, we talk about it in ETFs, the idea of raising your stop. So when you consider a stock replacement strategy, you're basically putting a stop in to the downside. The premium that you're willing to pay for that long exposure, is that stop. So I look at this and I say, I see what you see, Guy. This thing could break out in a big, big way. If that was the case, then the idea of just buying a call makes some sense, and you just let your profits run and you define it. But let's just look at a call spread, shorter dated here. The stock was trading around 54.20 or so today. Looking at July expiration, you could buy the 55.60 call spread. It costs you about $1.70 buying one of the July 55 calls for about $2.95, selling one of the July 60 calls at about $1.25. That $1.70 is your max risk. You break even at 56.70. You have gains of up to 330. That's basically 2x the premium that you're spending between 57.60 and 60 with a max gain above that. You're only risking that 170 between 56 and 170, or 56.70 and 55 to the downside, with a max loss of 55 to the downside. Again, you're risking about 3% of the stock price. It breaks even up about 5%, and your max gain is, up $6 or so. So it's a little tight, okay, I would say, because this would be, you feel kind of stupid if you got an epic breakout, and maybe you tighten this up, maybe you go to June or something like that. But again, if you thought this had the potential to, let's say, pull back a little bit and maybe a sharp pullback, the idea of replacing the stock with a call spread makes some sense.
It's creative, right? I mean, it's a creative way, because again, you're effectively getting out of your stock, right? And then you're just giving yourself, so you theoretically you have profits in the underlying stock, and then you're giving yourself some upside here into potentially an event. We'll see in terms of the commodity. It's it's sort of next level options trading, and this is something you're very good at.
Yeah, I mean, listen, you don't want to litter your portfolio with a bunch of long premium, hoping that stocks go up if you're owning calls, or hoping stocks go down if you own puts, that sort of thing. But again, look at the sharp move the stock has just had over the last few months. This makes some sense. Like, listen, you could look out to July expiration and buy the 55 call for about $2.95, but then your break even is at $58.95. The break even's much higher, right? And then the premium that you have at risk is much higher. So to me, this makes some sense, Guy.
Very cool. By the way, trading options might be new for you. Maybe been doing it for a while, Dan. Either way, Fidelity is your go-to source for clear and relevant information about trading options. For example, ask Fidelity professionals questions during their live small classes and coaching sessions, and learn more with educational videos, articles, and webinars. Plus, with Fidelity's straightforward tools and technology, you'll find it easier than ever to trade options your way. See what's waiting for you at fidelity.com/options. Options trading entails significant risk and is not appropriate for all investors. Certain complex option strategies carry additional risk. Before trading options, contact Fidelity Investments by calling 800-544-5115 to receive a copy of Characteristics and Risks of Standardized Options. Supporting documentation for any claims, if applicable, will be furnished upon request.
You are so good at that.
Some of those,
take a breath.
Some of those, it's
one thing
tongue tied.
It was before we get out of here. People, we hear from over social, in our email box, from like tons and tons of our listeners, our viewers. We really appreciate all the feedback. You ask us what you can do for us. Go follow the Market Matrix by Risk Reversal in your favorite podcast store. Go follow it, share it with your friends. We're really excited about this. We think it's going to be a great complement to our longer form pods. And again, the bonus is you don't have to listen to Guy and me. You can listen to, and we're not going to say the name because we want to hear from you, whether you guys like the name or not, our AI voice bot. He's pretty dope. He's a vibe guy.
You said he.
That's a little, it's a little hint. He's a vibe.
This would be great for like family members. Don't want
anybody. If you're just one of these people,
no, like
you have a real
my
job,
family members.
You have a real
they
job.
They get sick of hearing me.
You're doing things all day. Maybe you're a dentist. You know what I mean? Maybe you're doing...
You know who was a dentist? Hermie was a dentist. Remember in Rudolph?
Yeah,
that's coming up. Almost the holiday season.
Well, kind of.
You know what I like the most about it? And we got to get out of here.
Me too.
Put that up full screen. By the way, one of the great lines in cinema history is, "Let's be independent together." That's brilliant.
Yeah.
No, it really is.
No, it is.
Because, both guys are a little freaked out about things.
Deep.
They want to be independent,
it's deep.
But let's be independent together. You remember that?
Yeah. It's deep.
Are we on social media?
We're on the Instagram.
Well, why don't you put that slide up and check this out? I mean, we got all kinds of places you can follow us.
Hey, by the way, our team just started putting up a live video of Market Call on the Twitter. Again, we got it looks pretty good on the Twitter. So, follow us on the Twitter, follow us on the Market Call YouTube page, follow us on Instagram. We got a lot going on.
By the way, you ran through a lot of trades there. If I wanted to get them in my inbox, can I do that too?
Yeah, you know where you could go. You go to riskreversal.com, and Amanda and Jacob and Timmy, the whole team, they send out the show notes, a lot of our charts and more detailed information about the trade ideas. So go there, sign up, get them to your inbox, Guy.
We got a big On the Tape podcast coming up this week on Friday.
Yeah.
So should we even tease that?
Yeah, we got the Wall Street skinny, the ladies from the Wall. These guys,
they're badasses.
They're badasses, and the education that they're doing about our business is really fascinating. I don't see anybody else doing what they're doing. No. I'm also, right when I get off of here, sitting down with Gene Munster. Gene is the managing partner at Deepwater Asset Management. We're going to do a deep dive Nvidia preview. We're also going to go over some of the stuff going on in the Gen AI space and how that might play for Apple as they work into their Worldwide Developers Conference on June 10th. A lot to cover. Follow us. Stick with us here, people. Guy's going to be back tomorrow with Carter Braxton Worth.
CB Dubs.
I'm going to be on the West Coast. I'm going to take you down.
Come on.
I'll be back on Wednesday. Yeah. And then I probably
Wednesday. It's Elizabeth's on Wednesday.
Yeah.
And then Thursday is
Carter
Dubs.
again. Yeah.
And then if it's Thursday,
it's Butters.
Bitch. Yes, it is. So listen, I've enjoyed this. Game 7 tonight in the NHL.
Yeah.
No, I'm serious.
Yeah.
The Canucks of Vancouver.
I know, it's a huge one.
I mean, JT Miller's he's a man amongst boys.
Yeah,
He's an ex-Ranger.
I know you love him.
I mean, that's a good team, Vancouver.
They are.
I'm just saying.
I know.
And they're playing Edmonton, who's Connor McDavid is the best player in the history of hockey.
Yeah.
You can at me if you want.
I know. You've told.
And I know who Bobby Orr is. I know who Wayne Gretzky is. I know who Gordie Howe. I can rattle off names like nobody else.
You can rattle.
Best hockey player ever.
You don't get rattled. You can rattle, but you don't get rattled. All right, people, we got to get out of here. Thanks so much for being here with us. We'll see you tomorrow, Guy and Carter.
Options trading entails significant risk and is not appropriate for all investors. Certain complex option strategies carry additional risks. Before trading options, contact Fidelity Investments by calling 800-544-5115 to receive a copy of Characteristics and Risks of Standardized Options. Supporting documentation for any claims, if applicable, will be furnished upon request. Fidelity Investments and Risk Reversal are not affiliated. Views, opinions, products, services, and strategies discussed are not endorsed or promoted by Fidelity Investments. Fidelity Brokerage Services, LLC, member NYSE, SIPC.